Welcome back to Investing Talk Podcast.
Today we're looking at Rackspace Technology.
As usual, before we start, subscribe, like, and comment to this video to support the show because, well, we really need to talk about what just happened here.
Yeah, we do.
I mean, usually when we look at legacy tech, we're talking about companies that are, they're just slowly fading into the background.
Right, like a candle burning out.
Exactly. But then Rackspace drops their Q4 2025 earnings, and the stock doesn't just tick up, it goes completely vertical.
It really did. I mean, we saw a massive 31% pre-market surge.
31%.
Yeah. That isn't just a slight adjustment. That is a violent repricing event.
Right.
It forces everyone, even the people who completely wrote this company off years ago, to pay attention.
And I think that's the real hook for today for everyone listening. We have to figure out if this is a legitimate turnaround story. You know, a phoenix rising from the ashes of the data center.
Or if it's the classic dead cat bounce.
Exactly. A brief spasm of life before the inevitable slide into irrelevance. Because let's be honest, Rackspace has been battered and bruised for a very long time.
It has. But the narrative is definitely shifting. We're seeing this really specific pivot to AI, a solid revenue beat, and honestly, a valuation battle that is incredibly polarized right now.
Yeah, you have people looking at the chart screaming that it's a value trap, and others are shouting that it's the deep value play of the decade.
Which makes it fascinating to break down.
So let's unpack this. We've got the Q4 numbers, the guidance, the overarching strategy. But before we get too swept up in the stock price popping, let's pivot to the fundamentals. We have to look at the engine room here.
Right. We have to look at the actual health of the business itself, totally separate from whatever the ticker's doing on a screen.
Okay, so let's start with the headline numbers. Rackspace reported Q4 2025 revenue of $683 million. Now, analysts were expecting roughly $672 million.
So they beat the estimate.
They did. On paper, that looks like a clean win.
And a beat is a beat. It really helps stop the bleeding in terms of market sentiment.
However, and here's where I got to put my skeptic hat on for a second, if you zoom out and look at the full year context, the picture isn't exactly a portrait of explosive growth.
No, it's not.
Total revenue for the full year 2025 came in at $2.686 billion, and that is actually down 2% year over year.
Yeah, it shrank.
It shrank. So help me out here. The stock is up 31%. But the company is technically getting smaller. This isn't a rocket ship taking off. It's a vessel that is literally smaller than it was 12 months ago. Why is the market celebrating?
That's a totally valid observation, but you have to look at the quality of that revenue, not just the sheer volume.
Quality over quantity.
Exactly. This is a classic case where the headline revenue number hides the actual story going on inside the company. The shrinkage is largely coming from legacy businesses that they are intentionally de-emphasizing.
Okay, but intentionally de-emphasizing sounds an awful lot like corporate speak for we lost customers to Amazon.
I get that. But think of it this way. Imagine a high-end tailor shop that used to sell cheap, mass-produced T-shirts on the side just to keep the lights on during a tough time.
Okay, I'm with you.
Those T-shirts bring in revenue, sure, but they clutter the shop, they confuse the brand identity, and the profit margins are just terrible.
Right.
So Rackspace is basically stopping the sale of the cheap T-shirts to focus exclusively on the high-margin custom suits.
Okay, I like that analogy. So the T-shirts are the legacy hosting businesses.
Right, the low-margin, highly commoditized stuff where they can't compete on price anyway.
Got it.
They are trading that off for higher-margin, sticky public cloud services. If you look at that segment specifically, the custom suits in our analogy, it brought in $442 million in Q4 alone.
And what's the growth on that?
That segment is up 6% year over year.
Okay, so the core argument is that they're shedding bad revenue for good revenue.
That is the entire thesis right there.
Yeah.
They are trading volume for value. If you look at the full year for public cloud, it's up to nearly $1.7 billion.
Which is the bulk of their business now.
Right. It's growing, albeit slowly at 1% for the year. But that acceleration in Q4, that 6% jump, that's the key. It suggests the pivot is actually starting to gain traction exactly when they need it to.
I see. So the 6% growth in Q4 is a leading indicator that the tailor shop strategy is working.
And it leads directly into the profitability story,
Right.
which is honestly the most impressive part of this entire earnings report.
Because if they were just shrinking without getting more efficient, that would be a massive red flag.
Exactly. If the margins were compressing while revenue dropped, it would be a disaster. But the bottom line tells a completely different story.
Let's get into that bottom line then. Because even if revenue is flat-ish, the profit metrics look wild.
It's night and day. The margins have improved so sharply. Non-GAAP operating profit rose to $41 million in Q4. And for the full year, operating profit hit $126 million.
126 million.
Yep, that is up 19% from 2024.
19% growth in operating profit, while revenue dipped 2%. That is, that's squeezing blood from a stone.
It's extreme operational discipline.
Uh-huh.
And adjusted EBITDA hit $276 million for the year.
Wow.
Right. This tells us that the cost cuts, the restructuring, and this laser focus on the AI pivot are actually flowing all the way through to the bank account.
They aren't just burning cash chasing an AI dream.
No, they are becoming a leaner, much more profitable operation.
Which brings us to the forward guidance for fiscal year 2026. Because this is usually where the rubber meets the road for tech stocks.
Absolutely.
They are projecting revenue of $2.6 to $2.7 billion.
Correct.
And now hold on. The consensus estimate from analysts was around $2.719 billion.
Yeah.
So the midpoint of their guidance is technically a miss. They are telling Wall Street they're going to make less money than Wall Street expected. Usually that tanks a stock by 20%.
Usually, yeah.
Why did it surge 31% on a guidance miss?
Because the market has finally stopped obsessing over top-line revenue growth at any cost. And they've started rewarding profitable growth.
Okay, so the profit guidance must be good.
It's very good. The guidance for operating profit in 2026 is $160 to $170 million.
Oh, wow. Compare that to the $126 million they just did.
Exactly. That is a massive step up in profitability.
So the market is basically looking at Rackspace and saying, we don't care if you don't get bigger, as long as you get richer.
Essentially, yes. The market looks at that margin expansion narrative and says, okay, you might not be growing sales massively, but you are going to make a lot more money on the sales you do have. It's a pure efficiency and modernization play.
And we can't forget the financial health aspect here. Let's check the bank account. What's the cash position looking like to actually fund this AI pivot?
They ended the year with $106 million in cash and equivalents. Total liquidity is sitting around $397 million.
$106 million in cash doesn't sound like a massive war chest for a tech company trying to pivot into artificial intelligence. Google probably spends that on office snacks in a month.
You're not wrong. It's not a massive war chest. But you have to look at the free cash flow.
Okay.
Operating cash flow was $60 million in Q4 alone. So they're generating cash now, not burning it.
That's a huge distinction.
And their capital allocation strategy is very clear. They aren't paying dividends. They aren't doing any stock buybacks. They are taking every single dollar of that free cash flow and reinvesting it straight into AI and cloud growth.
Which makes sense. If you're trying to reinvent your entire business model, you really can't be handing out dividends to shareholders.
Exactly.
But I want to touch on something you mentioned earlier, the competitive moat. Because Rackspace isn't Amazon AWS and it isn't Microsoft Azure. They are essentially a middleman.
Right.
What stops an enterprise client from just firing Rackspace and going direct to Amazon? Why pay the middleman at all?
That is the billion-dollar question for this company. And the answer lies in complexity. The moat here is built on switching costs and the sheer messiness of modern corporate IT.
Explain that for the listeners.
So Rackspace handles end-to-end hybrid cloud. Most big enterprises don't just use one cloud provider. They use AWS for some things, Azure for Microsoft tools, Google Cloud for analytics.
A multi-cloud setup.
Right. And this is crucial. They also have private servers sitting in a dusty basement somewhere because of strict security or compliance regulations.
So it's a Frankenstein monster of data.
It's a complete disaster to manage. Rackspace is the company that untangles that mess.
So they're basically the janitors of the cloud.
I prefer architects, but sure,
Okay.
janitors works too. Think about AI orchestration, which is their massive buzzword right now.
Okay.
Imagine a Fortune 500 company wants to run a powerful AI model. That AI needs data to learn. But the data is stuck in 3 different silos that don't talk to each other.
The basement, Amazon, and Microsoft.
Exactly. Rackspace builds the customized pipes that connect all that disparate data so the AI can actually read it safely. That is orchestration. It's the plumbing for enterprise intelligence.
Okay, so they are the plumbers connecting the basement server to the AI brain.
And that plumbing is incredibly sticky.
Sticky meaning hard to rip out.
Very. Think of it like the nervous system of an office building. Rackspace isn't just a piece of software you install and delete later. They actively manage the connections between your private servers and the public cloud.
So trying to fire them would be a nightmare.
Ripping them out is like trying to perform open-heart surgery on yourself while running a marathon. It is way too risky for most chief information officers to even attempt unless they absolutely have to.
That makes total sense. Once Rackspace is embedded in the daily workflow, they just stay there. It's a service business built on dependency.
That stickiness is how they survive. They aren't trying to beat AWS. They are partnering with AWS to help big clients actually use the platform effectively.
All right, we've covered the spreadsheet side of things. The business is shrinking slightly, but getting much, much more profitable. Let's pivot to the charts.
Let's do it.
Because that 31% move is what brought everyone here today. What does the price action tell us about the psychology going on here?
It tells us the market has completely shifted its view on the stock overnight.
Really?
Yeah. For a long time, Rackspace was priced as a distressed asset. The market was essentially pricing in a high probability of failure, or at least total irrelevance.
Right.
This surge is a fundamental re-rating from distressed to a turnaround or even a growth story.
So it's a confirmed breakout?
It is a breakout, directly triggered by that earnings beat. When you see a stock gap up 31% and actually hold those gains throughout the session, it indicates that institutional money is likely waking up.
They're looking at the new thesis and deciding to buy in.
Exactly.
Well, let's talk about valuation then, because even after a 31% pop, where does this thing actually sit? Is it expensive now?
This is where it gets absolutely fascinating. The price-to-sales ratio, the PS, is sitting around 0.14.
0.14.
0.14.
That is absurdly low.
Wait.
Let's put that in context for you listening at home. A really boring utility company might trade at 2 times sales. A hot AI stock is going to trade at 10, 20, sometimes 50 times sales.
Right.
And Rackspace is trading at 0.14.
Exactly. To put it another way, Rackspace is trading at 14 cents on the dollar. The market is effectively still pricing them as if they are heading into bankruptcy liquidation.
But is that a bargain or is it a trap? Because usually when something is that cheap, there's a reason. It's like finding a Ferrari on Craigslist for $5,000.
You assume the engine is missing.
Right, or it was caught in a flood.
True.
Oh.
But the bet here is that the market thought the engine was missing, and Rackspace just turned the key and the engine roared to life.
Ah.
The market is realizing that maybe the engine, which is their profitability, is actually running smoothly now.
So if they just stabilize...
Yes, if they stabilize. They don't even need to grow massively. If they just stabilize and hit that margin improvement they promised, a PS of 0.14 is incredibly deeply cheap.
And the volume on the chart supports that idea. We saw it hitting top gainer status across the boards. That brings a lot of retail and institutional eyeballs.
It does. High volume on an up move confirms the strength of the trend. It's not just a few retail traders playing around. It suggests much broader interest.
Which segues nicely into the mood of the market. Let's move over to market mood and news.
The vibe has definitely shifted.
I mean, current mood is bullish. Clearly, you don't get a 31% gain with bearish sentiment. But what's driving it specifically right now? Is it just the numbers or is it the story?
It's the combination of both. If you look at the Alpha Vantage and FinHub news sentiment feeds, they are completely lighting up because of that massive gain.
Price drives narrative.
Always. But specifically, it's the Q4 revenue beat combined with the intense focus on AI. Investors right now are desperate for AI plays that haven't already gone up 1,000%.
So Rackspace looks like a cheap catch-up trade.
Exactly.
And the earnings beat wasn't small on the bottom line. Q4 EPS beat estimates by over 66%.
That is a massive surprise to the upside.
It is.
And when you beat EPS by 66%, it forces analysts at all the major desks to completely rerun their models.
So are we expecting upgrades?
We haven't seen a flood of official upgrades yet, but the market pricing implies they're definitely coming.
I do want to drop a reality check here, though. We talk about institutional interest waking up, but looking at the actual flow data,
Right.
are we seeing the smart money really backing up the truck?
That is an important nuance to catch.
Because I'm looking at the flow data, and there are no specific reports of cluster buying.
No, there aren't.
We aren't seeing big Form 4 filings dropping where the CEO and CFO are buying millions of dollars of stock with their own personal money, and we aren't seeing massive 13F accumulation reports from hedge funds yet.
You're right. This isn't an insider conviction play yet.
Exactly. This feels purely like operational momentum. Business is doing better, so the stock is reacting. But the insiders aren't necessarily loading the boat before the news drops. This is a reaction, not a premeditated heist.
That's a very fair assessment. It's a show-me story right now. The insiders are executing the plan, but they aren't aggressively buying the stock themselves yet. They might be waiting to see if this newfound stability actually holds for another quarter.
And then there's the rumor mill. We have to touch on the speculative catalysts floating around. What's the whisper on the street right now?
Well, there is this narrative circulating about a deeper potential partnership with Palantir.
Oh, really?
Yeah. The idea is that Rackspace could act as the core infrastructure partner for some of Palantir's heavy lifting in the enterprise AI space.
And there's a specific revenue number floating around with that rumor, right? Something about $2.8 billion by 2028?
Yes, that's the projection being bandied about in the forums.
Mm-hmm.
If they can hit $2.8 billion in revenue by 2028, that represents a steady compound annual growth rate of about 1.4%.
So it's not hypergrowth.
No, but it's steady, profitable growth. But again, we have to treat this as entirely unconfirmed.
Right.
It's part of the bull thesis, but it is not in any signed contracts that we've seen yet.
Rumors are fun, but rent is paid with facts.
Exactly.
And speaking of bills to pay, let's look at the risks now. Because it can't be all sunshine, and a stock trading at 14 cents on the dollar usually has some serious skeletons in the closet.
With Rackspace, it's more of a graveyard than a skeleton.
Let's talk about the debt load. This is the big risk, isn't it? Let's execute a breakdown on this balance sheet.
Go for it.
Total liabilities are sitting at roughly $4 billion.
Yeah.
And total assets are roughly $2.8 billion.
That's a completely inverted balance sheet.
That is underwater. Liabilities exceed assets by over $1 billion.
It's rough.
And the current ratio is 0.7. For anyone listening who doesn't spend their weekends reading accounting textbooks, a current ratio under 1.0 means you have more short-term bills coming due than you have liquid cash and assets to pay them.
It absolutely indicates potential liquidity tightness.
It means they are walking a very thin tightrope.
They have to manage their cash flow perfectly. If they miss a payment, or if interest rates spike right when they need to refinance a chunk of that debt, things could get ugly extremely fast.
This has to be the core argument for the bear case. The company is highly leveraged. If this turnaround stalls out, if that operating profit growth hiccups for even a single quarter, that debt becomes a massive anchor.
It could drag the whole thing down.
Yeah.
That is the fundamental risk. The equity is priced this cheaply specifically because the debt is so high.
So you're essentially buying a call option on the company surviving its own debt load.
Basically, yes. However, the counter-argument, and why I'm still optimistic here, is that the $397 million in liquidity and the newly positive free cash flow give them enough runway to deleverage over time.
If they execute.
Right. If they keep printing $276 million in EBITDA every year, they can comfortably service that debt.
If. That's a big if.
Yeah.
And then there's the guidance concern we touched on earlier that they guided for 2.6 to 2.7 billion. Wall Street wanted 2.719.
Yes.
If they miss these internal targets, if they come in at the low end of their own, guidance sentiment could reverse in an instant.
Oh, absolutely.
This entire valuation is based on a very delicate recovery narrative. It's like a souffle. If you slam the oven door, the whole thing collapses.
That's a great image for it.
Mm-hmm.
There is almost zero room for error right now. The market has given them a temporary pass on the top-line revenue shrink because the margins went up. But if those margins slip,
The forgiveness evaporates entirely. And finally, we have to talk about execution risk. Can they actually pull off this AI pivot? They're out there competing for talent against Google, Microsoft, Amazon. Everyone wants top-tier AI engineers right now.
It is an incredibly crowded and expensive space.
Can Rackspace, a legacy hosting company from Texas, really compete for the best talent to build these specialized AI orchestration tools?
It's tough, but remember the plumber analogy from earlier. They aren't trying to build the next large language model. They aren't trying to build the next ChatGPT.
Right.
They are simply helping regular companies implement the tools that Google and Microsoft build. That requires IT professionals, cloud architects, system admins. That is Rackspace's core DNA. They have been doing high-level enterprise support for 20 years. This is just a new, more complex layer of that exact same support.
That's a very fair distinction. They are the mechanics, not the car designers.
Exactly. And right now, the tech world has enough car designers, but we're desperately short on qualified mechanics who know how to fix the engine.
All right. We've looked at the good, the bad, and the very ugly debt load. It's time to make a call. Let's move to the final decision.
Okay, let's do it.
You've crunched the numbers, you've looked at the chart breakout, and you've stared deep into the abyss of that $4 billion debt load. What is your verdict?
After weighing it all, I am giving this a bullish score of 7 out of 10.
A 7 out of 10. That's fairly confident given the underwater balance sheet we just discussed. What's the core thesis for the 7?
The elevator pitch is this. Rackspace has officially hit an inflection point. The 19% growth in operating profit and the acceleration in that public cloud segment prove that the turnaround strategy is actually working.
It's not just talk anymore.
No, it's no longer theoretical. It's right there in the numbers.
Yeah.
They are successfully swapping bad revenue for good revenue.
So the proof is in the pudding.
The proof is in the margins. And the catalyst going forward is continued margin expansion. If they hit their guidance of $160 to $170 million in operating profit for 2026, the market simply cannot keep the stock valued at 0.14 times sales.
It's a mathematical anomaly at that point.
Exactly. It completely supports a significant re-rating from these levels. The risk-to-reward asymmetry is heavily tilted to the upside, even with the debt.
It's just too cheap to ignore if they actually hit those profit targets.
Precisely.
So how do you actually play it?
Strategy-wise, I view this initially as a swing trade into the next earnings cycle.
Okay.
You ride the momentum of this current breakout. The chart is highly bullish, the institutional volume is there, but it has the potential to extend into a multi-year hold if and only if they continue to execute flawlessly on the AI orchestration side.
So you take it one quarter at a time.
You watch it quarter by quarter. If the margins keep rising and the debt is serviced, you keep holding.
So don't marry it, but definitely date it.
Date it with intention, but keep one eye firmly on the exit door in case that debt load starts knocking.
I really like that. Date with intention. It's a high-risk, high-reward play on a legacy tech company finding a very aggressive second wind.
That is the best way to describe what we're seeing here.
Well, that wraps up our breakdown of Rackspace Technology, a fascinating story of debt, AI plumbing, and a 31% surge that completely woke up the market.
It is definitely going to be an interesting year for them.
It certainly will. As always, thank you for listening. Make sure you subscribe, like, and drop a comment below. Tell us, do you think Rackspace is a massive value trap, or is this the turnaround story of the year? We want to hear your take.
See you next time.
Class dismissed.